Your base case for the Fed tomorrow?
Yeah, I mean, I think markets are widely expecting that 25 basis point cut tomorrow. What's going to be really interesting to us is to see what happens with that dot plot. If you think about the fact that the Fed target rate is likely going to be somewhere between 175 and 200 basis points tomorrow, that's already below what the Fed told us in June was going to be the target rate for all of 2020, right? So we've got to see those dots revised, and it's going to be interesting to see kind of where those land, how wide this dispersion is, and of course, some of the language out of Powell in the press conference to see, is this really a mid-cycle adjustment, or is this the start of a more prolonged easing cycle?
And, you know, the real wild card is going to be what they do and how they talk about oil. I mean, if you come inside the Bloomberg, this is oil versus the five-year forward break even, and they tend to actually track each other quite well. And as oil rallied yesterday, you saw the break even come up too. I mean, we're now over 2%. It's the wrong type of inflation. What did they do?
Yeah, sure. So one thing that's interesting is that the dots were already submitted prior to what happened with oil prices over the weekend. So that's something to think about. Certainly they'll address it in the press conference, is my guess. But what's so kind of interesting about this is the inflation expectations. We expected them to just skyrocket coming into work on Monday. And we really haven't seen that. If you look at TIPS yields, we haven't really seen that play out. We thought that bond yields would back up in a big way and continue that rally based on higher inflation expectations. And in fact, as you mentioned, the market's actually been quite complacent. And in our view, that means that this event, as it relates to oil, has actually had less to do with inflation and more about kind of adding to the pile of geopolitical risks that investors are dealing with today. And that could actually prove to be deflationary in the long term.
Right, and that's a great point you make. And I should also point out that, as I mentioned before, it's in other asset classes. Like the complacency when you come in here and oil's down and you didn't see that huge move in bond yields that you might have expected over the last 48 hours. Why?
I mean, all eyes are certainly going to be on the Fed tomorrow. Investors may be waiting for that. We're looking for, more around that. We're also looking for the leading economic indicators, which comes out on Thursday. That's one of our best kind of recession monitors, and we use that to make calls about the cycle. And we're looking at an environment which we've seen two consecutive prints of 1.6% year over year on the leading economic indicators. This is really kind of decision time in terms of seeing where the cycle is going. Is this another kind of mini recession, mini slowdown that can actually be reaccelerated by dovish central bank policy, or are we really kind of in for an environment which we're heading into the next recession? Some of these data points this week are really going to be critical here.